These are times of uncertainty, both as our health is concerned and as the economy is concerned. This is Michael, and today I'm going to talk about personal finance in a recession and a crisis. I'm going to go over why you should have an emergency fund, track your spending, where and when and how to invest, and the number one way to guarantee you keep generating income. So I've said this in a previous video, but you must develop an emergency fund if you want to feel safe. An emergency fund is about 6 months of your expenses saved up in a liquid asset like cash. So this is money that should be easily accessible. So the first step, and this is where all your extra money should go to, is building up that emergency fund. Next thing we want to do is we want to track our spending and minimize expenses. So I highly recommend you look into mint.com and you link up your bank accounts and investment accounts and then track exactly where you're spending and see where you can cut down on expenditures to keep more of that money so you can ultimately invest it or put it towards your emergency fund. So mint.com, you just link your accounts and it tells you where you're spending your money and figure it out. So I'll let you know the 2 places you should be spending your money and where you can cut out on expenditure. Remember that happiness is not correlated to income and only goes up to about, in the United States, $75,000. You get happier until you reach that point, and beyond that, it's not correlated to happiness. But at the same time, your income is correlated to the amount of value you create. So think of those 2 things. Next, invest. And this is something I want to drill into you. I've said this in a previous video, but you have to remember the concept that time in the market beats timing the market. Now, what do I mean by that? The market is going to have fluctuations, but over the long run, if you invest in an aggregate index fund, it tends to go up over the last 100 years. So time in the market beats timing the market. That means you want to consistently invest in the market no matter where it is, because no one knows what's going to happen tomorrow in the economy. It might go up 10%, it might go down 10%. Remember, fortunes are made at the bottom of the market. So that's the best time to invest when things are relatively discounted. Right now, because of the fear and panic due to this pandemic, the market has dropped, but it has to be priced into the market, meaning you're taking account for all this fear and panic taking place. So I've always recommended, and Warren Buffett recommends this, but before I say this recommendation, I'm not a personal advisor, a financial advisor. I have worked on finance and Wall Street, but all your financial decisions must be your responsibility. So I recommend an index fund, and this is recommended by Warren Buffett. And to index is 2 things: the general stock market, or the S&P 500 if you're in the United States, and bonds. And this balance should be according to your risk tolerance. They say the older you are, the more bonds you should have, and the younger you are, the higher risk tolerance, the more stocks you should have. But index funds are what's recommended by Warren Buffett and the way to go. Now, in this recessive economy, there are going to be a lot of layoffs as companies make less profits and they can't meet payroll. And there are 2 ways to secure your position, actually 3 ways. So I'm calling this concept skilling up. You want to invest in your personal education and skill development to increase what I call your indispensability in the workplace, whether you're an entrepreneur or working 9 to 5 for a corporation. You have to become indispensable, and there are 2 ways to do this. One is to become better at what you do than anyone else and invest in skills, and the next thing is to become more likable. The last person to be fired is the most popular in the office, and there have been many stories about the asshole that was productive being fired over the likable, lazy person. So take into account your indispensability and your likable factor. And both are habits that can be trained into you. So that's it. Build a 6-month emergency fund. Track your spending on mint.com. Invest steadily into the market over the long run, and think in terms of a 10-year period, 20-year period, 30-year period, and the index fund is the way to go. Individual stocks tend to fluctuate, it's like betting, but if you bet on the whole market, you're way more likely to win. And Warren Buffett, I'm going to repeat this, says it's best for about 90% of investors to do this. And skill up, invest in your personal education, and that is how you win in a recession. Thank you.